Hello everyone, welcome to the June 16th Tuesday edition of the Market Opening Bell, your 10-minute guide to the stock market. The text of the U.S.-Iran Memorandum of Understanding has been finalized and will be officially signed this Friday in Switzerland. The Hang Seng Index opened higher by 283 points, breaking through the 25,000 level and rising more than 300 points at one point to a high of 25,048 points. It later narrowed its gains, failed to hold above 25,000 and closed at 24,842, up 124 points or 0.5%. Total turnover for the day was 283.3 billion Hong Kong dollars. The Hang Seng Tech Index closed at 4,765, up 60 points or 1.3%. The X-Share Index closed at 8,375, up 1 point or 0.02%. Southbound funds recorded net purchases of 2.11 billion in Hong Kong stocks. Among them, net buying included Zhipu at 2.294 billion. Kingboard Laminates at 1.021 billion, Kingboard Group at 534 million, PopMart at 407 million, and SMIC at 335 million. Net selling included Alibaba at 853 million, Sinuk at 651 million, Tencent at 487 million, Yangtze Optical Fiber and Cable at 471 million, and Hua Hong Semiconductor at 255 million. According to statistics, Southbound funds have net bought Kingboard Laminates for 6 consecutive days, totaling 4.079 billion. Net bought SMIC for 3 consecutive days, totaling 563 million, and net sold Alibaba for 5 consecutive days, totaling 6.747 billion. Technically speaking, the Hang Seng Index round number psychological barrier at 25,000 points also coincides with a previous dense consolidation zone full of trapped positions. To sustain the upward momentum and continue the recovery, the index must reclaim this level with a strong bullish daily candlestick supported by significantly high trading volume. Buoyed by the positive performance in overseas markets, the Hang Seng Index is expected to test the 25,000 point level again today. If it manages to stabilize above 25,101 points, the next upside target would be 25,441 points, which represents roughly half of the previous decline during the rebound. The 3 major A-share indexes opened higher by 0.6% to 1.7%, with gains expanding during the session to close up 1.6% to 5.3%. The Shanghai Composite Index closed at 4,096, up 64 points or 1.6%. The Sun.King Component Index rose 567 points or 3.8% to close at 15,531. The Chinex Index surged 203 points or 5.3% to 4,033. Combined turnover in Shanghai and Shenzhen reached 3.04 trillion yuan. The renminbi central parity rate against the US dollar was set at 6.8088, up 21 pips from the previous day, marking the highest level since February 10th, 2023. In terms of sector movements in Hong Kong stocks, photovoltaic and solar stocks rallied. Reports indicated that on June 11th, media sources stated that the mandatory national standard for energy efficiency limits and energy efficiency grades for crystalline silicon photovoltaic modules and inverters has entered the final approval stage before release and is expected to be officially issued soon. The market expects the introduction of the mandatory third-tier energy efficiency standard to directly phase out approximately 30% of backward and inefficient capacity across the industry. Currently, the supply-to-demand ratio for silicon materials, solar cells, and modules remains as high as 2 to 1, and industry leaders such as LONGi, Green Energy continued to face varying degrees of loss pressure in the first quarter. After years of explosive growth, global demand has entered a phase of moderate growth. The China Photovoltaic Industry Association forecasts that new global photovoltaic installations in 2026 will fall back to 580 gigawatt to 650 gigawatt, slightly down from the near record high of nearly 700 gigawatt in 2025. Meanwhile, anti-dumping and countervailing policies in Europe and the United States continue to escalate. For example, the EU has introduced the photovoltaic products carbon footprint certification rules, requiring full life cycle certification for products entering the market from 2026 onward, while the US has further tightened local production requirements. The supply-demand situation in the photovoltaic industry remains challenging in the short term, with structural and substantive marginal improvements expected only by the end of 2026 to 2027. Hong Kong-listed paper stocks also rallied, with 9 Dragons paper surging more than 11%. The company announced the full redemption of $400 million in perpetual capital securities, with a high coupon rate of 14% and approval for a 2 billion yuan loan, which has had an extremely significant positive impact on its fundamentals, financial structure, and share price. These perpetual bonds were issued in June 2024 with a 14% coupon rate, representing very high cost financing. In accounting terms, perpetual bonds are typically classified as equity rather than liabilities, and the high distribution interests takes priority in deducting the company's net profit. After fully cancelling and retiring these perpetual bonds, all future profits will belong entirely to ordinary shareholders, laying a solid foundation for the company to resume higher ordinary dividend payouts. The funds for the redemption mainly came from a newly signed 3-year cross-border renminbi syndicated loan of 2 billion yuan at an interest rate of only 2.73%, with the balance covered by internal funds. Replacing the 14% US dollar financing with 2.73% renminbi financing, it's expected to save the company nearly 300 million yuan in annual interest expenses, which would directly translate into net profit and significantly boost future earnings per share. In recent years, the renminbi has shown an appreciating trend against the US dollar. Management chose this time to exchange renminbi for US dollar to carry out the redemption, gaining a significant exchange rate advantage. Preliminary calculations show this forex operation brought the company an additional foreign exchange gain of about 200 million yuan. Combining interest savings and exchange rate benefits, this proactive debt management has effectively saved the group up to 500 million yuan. For general bondholders, valid surrender of securities before June 26 can receive an early bird consideration of $1,070 per $1,000 principal, representing a 7% premium. Executive Directors Zhang Yin, Liu Mingzhong, Zhang Chengfei, and their associates collectively hold up to 81% of the unredeemed principal. They have explicitly committed to foregoing the early bird period and surrendering afterward, receiving only the $1,000 face value, foregoing a $23 million premium. The major shareholders voluntarily reducing their interest income to cut company expenses has greatly boosted market confidence in the company's corporate governance in Hong Kong. Additionally, domestic paper enterprises have recently implemented successive price increases, which in the short term will help drive further improvement in performance and profitability for the paper sector. Zhipu saw 33% after major institutions raised their target prices, and JLM 5.2 was made available to all JLM coding plan users. This represents a major historic breakthrough for domestic AI in both the open source ecosystem and global geopolitical substitution dimensions. Just days ago, US AI giant Anthropic suddenly announced the removal of its most advanced coding models, Claude Fable 5 and Mythos 5, from overseas markets outside the US, just 3 days after release due to government national security directives. At this moment, Zhipu quickly launched GLM 5.2 over the weekend with the stance that technology should not be monopolized by a few, nor withdrawn at will, directly taking over the wave of high-end users lost due to restrictions and firing the first shot in domestic substitution. GLM 5.2's technical specifications directly benchmark top Western coding models. Previously, large models' code capabilities were limited by context length and could not handle large projects. GLM 5.2 supports a 1 million window, meaning developers can feed entire complex code repositories directly to the model for repository-level bug fixes and code architecture refactoring. Although GLM 5.2 is a high-end model benchmarking Claude Opus, has relatively high regular consumption coefficients, Zhipu has introduced to a limited time offer until the end of September of one-time deduction during off-peak hours, and its overall coding plan subscription cost is far lower than comparable Western products, offering extremely strong value for money. AAC Technologies rose 6% after announcing that its surface relief grating SRG diffractive optical waveguide lens products have passed performance and reliability tests from multiple global leading-end customers, securing mass production nominations. Some projects have already entered the ramp-up delivery phase. Based on customer demand forecast, the company expects a scaled mass production and shipment window starting from the second half of 2026. As a core optical component of AR glasses, the optical waveguide display module directly determines device appearance, visual performance, and wearing experience, serving as a key bottleneck constraining large-scale industry adoption. Optical waveguide products have thus become an essential track for the explosive growth of the AR glasses industry. On the ecosystem front, AAC Technologies is partnering with its globally leading diffractive optical waveguide subsidiary, Displex, and top global end device manufacturers to jointly develop next-generation AR glasses display modules. With AI technology accelerating commercialization, consumer-grade AR glasses have reached a commercial inflection point. Global shipments of consumer AR glasses have grown over 70% year-on-year in the past 2 years, and the industry is expected to see explosive growth waves from 2027 to 2030. As a core optical component, optical waveguides, with the advantages of thinness, high transparency, and high definition imaging, effectively address the industrialization pain points of traditional AR optics and represent the optimal technical route for large-scale adoption of consumer-grade AR. Café de Coral Group released its latest full-year results, characterized by full-year profit decline, strong second-half recovery, and substantial dividends as a floor, driving the share price up 16%. For the year ended March 31st, 2026, the group's total revenue reached 8.183 billion Hong Kong dollars, down 4.5% year-on-year, while net profit was $164 million, down 29.5%. Gross margin narrowed by 0.9 percentage points to 9.5%, mainly due to intense price wars and subdued consumer sentiment in both Hong Kong and mainland catering sectors. The company faced pressure from local residents' normalized northbound consumption and outbound travel, and shifts in visitor spending. Same-store sales for Café de Coral and One Pot One Noodle in Hong Kong fell 6% and 9% respectively, with a net reduction of 7 stores in Hong Kong. The company has shifted to an extreme high value for money strategy, such as 29 Hong Kong dollars breakfast, $39 lunches, and $100 family sets to lock in local essential customer groups, with its Club 100 membership now exceeding 2.2 million. In renminbi terms, South China fast food revenue and same-store sales declined 4% and 9% respectively. However, Café de Coral continued counter-trend expansion in the mainland, adding a net 23 new stores in South China during the year to prepare for the Greater Bay Area economic recovery. Notably, after the first half downturn, second half profits surged 151.1% from the first half and grew 32.2% compared to the same period last year, indicating initial success from business restructuring measures implemented since the third quarter of last year. Although basic earnings per share were only 29 cents, the group declared a final dividend of 30 cents, bringing the full-year total to 40 cents, flat with last year, with an actual payout ratio as high as 141.4%. Management's willingness to use accumulated reserves to reward shareholders, combined with a $50 million share repurchase program, has provided strong support to the share price. U.S. stocks advanced on Monday, with the Dow Jones Industrial Average rising 0.9% to close at 51,671 points, surpassing the previous record closing high set on June 4th and reaching a new all-time high. The Nasdaq Composite climbed 3.1% to 26,683 points, while the S&P 500 index gained 1.7% to 7,554 points. All three major indexes recorded gains for the third consecutive day. The fear gauge fixed index fell 1.48 points or 8.4% to 16.2 points. The Nasdaq China Golden Dragon Index, which tracks Chinese stocks listed in the U.S., rose 24 points or 0.4% to close at 6,351 points. Most sectors closed higher, led by a 3.4% gain in technology stocks, while the energy sector posted the largest decline. Western Digital surged nearly 16% after major brokerages raised their target prices, citing rising demand for hard disk drives. It was the best performing stock among S&P 500 and Nasdaq constituents. Nvidia rose 3.5%, making it the second largest gainer in the Dow Jones Industrial Average. Reports indicated that Nvidia plans to raise at least $20 billion through its first corporate bond issuance since 2021. Micron Technology jumped 11% after major institutions significantly raised their target prices. The upgrade was based on the view that the company deserves a higher valuation amid the AI-driven memory cycle recovery and tightening industry supply conditions. Fox shares plunged about 16%, becoming the worst performer in the S&P 500. The company agreed to acquire Roku in a deal valued at approximately $22 billion in cash and stock. The merged media and technology company is expected to own one of the largest streaming businesses in the United States. Roku serves over 100 million global streaming households through its streaming players, televisions, and the Roku channel. Both parties stated that the combined entity would become the third largest television company by U.S. viewership market share. Fox owns the Tubi streaming service. Fox expects the transaction to generate $400 million in annual cost synergies and offers room for revenue growth. SpaceX surged 20% after rising 19% on its first trading day last Friday. U.S. industrial production in May rose 0.1% month-on-month, below the expected 0.3% and slower than the upwardly revised 0.9% increase in April. Capacity utilization rose from 76.1% in April to 76.2% in May, in line with expectations. The New York Federal Reserve reported that the Empire State Manufacturing Index fell from 19.6 in May to 5.7 in June, lower than the expected 13.5, signaling a slowdown in the pace of expansion. The Federal Reserve begins its two-day interest rate meeting today, chaired for the first time by the new chairman, Kevin Warsh. The market widely expects the Fed to keep interest rates unchanged, marking the fourth consecutive meeting with no action. Our stock pick today is Sun.King Technology, stock code 580. Sun.King Technology is primarily engaged in the manufacturing and trading of power electronic devices. Its products can be divided by application fields into power transmission and distribution, electrified transportation, as well as industrial and others. In the power transmission and distribution sector, the group supplies products such as anode saturable reactors, power capacitors, DC support capacitors for flexible DC transmission, smart grid online monitoring systems, and distributed power semiconductor devices to conventional DC transmission and flexible transmission subsectors. In the electrified transportation field, the group provides various power electronic devices for traction converter systems to rail transit vehicle equipment manufacturers. It also supplies laminated bus bars, integrated bus bars, and self-developed power semiconductors, including insulated gate bipolar transistors, IGBTs, and silicon carbide, SiC products, to the electric vehicle subsector. In the industrial and other fields, the group offers self-developed power semiconductors, laminated bus bars, integrated bus bars, power quality management devices, power capacitors, DC support capacitors, and distributed power semiconductor devices to manufacturers of industrial control equipment, energy storage equipment, and new energy power generation equipment, as well as to research institutes and clients in other subsectors. In 2005, the group launched IGBT and FRD chips using 7th generation micro trench technology, raising the current capacity of its 1200 volt and 1700 volt chip products to an industry-leading 300A. On the IGBT module side, it introduced 4 product series: EP packaging, FP packaging, TF packaging, and BEVD packaging, and added ED packaging and ST packaging models. As a result, the number of available IGBT module models increased to 37 from 12 in 2024. The continuous launch of new products was a key driver behind the rapid 104% growth in self-developed power semiconductor revenue in 2025. During the year, the group added 55 new signed customers, covering many leading enterprises in photovoltaics, energy storage, industrial control, and commercial electric drives, achieving significant breakthroughs, particularly in the power supply and commercial electric drive sectors. The progress aligns with the deepening trends of industrial electrification, transportation electrification, and building intelligence, alongside a sharp rise in electricity demand from artificial intelligence in data centers. The group develops and produces power semiconductor chips and modules such as IGBT, FRD, and SiC, including products suitable for the green electricity plus energy storage plus computing power sector. It officially entered the new energy power station construction business in 2023 and achieved scale in 2024. In 2025, revenue from the new energy power generation and energy storage subsectors reached approximately 576 million yuan, representing a 111% increase from 2024. In 2026, the group will focus on the research and development of new SiC MOSFET and IGBT products targeted at photovoltaics, wind power, electric drives, data center power supplies, and other fields to deeply serve the development needs of the industry. Green electricity plus energy storage and computing power synergy have become key directions for the new energy industry. Investment recommendations suggest the buying price $2.65, target price $2.90, and stop loss at $2.50. I do not hold the above stock.